For 50 years, there's really only been one name that set the gold standard in venture capital: Sequoia. But after the most tumultuous year in its history, that empire is changing. So today, we're doing a briefing for any limited partner asking that one crucial question: what on earth comes next for Sequoia Capital?
You know, this quote from Peter Drucker, it really just nails the challenge here. For decades, Sequoia's logic was the winning formula. But in this new world of high interest rates and geopolitical fractures, that old playbook, it might not work anymore. So the question for every LP has to be, is Sequoia really adapting? Or are they just reacting with yesterday's logic?
And yeah, that's exactly what we're going to unpack today. We're going to dig into their recent moves to figure out if this is a truly strategic pivot for the next 50 years, or if it's a reaction that could actually signal a decline.
Look, before we can get into the chaos of the last year, you have to appreciate the sheer scale of the legend we're talking about. Sequoia wasn't just another firm. For half a century, it was the institution that basically set the gold standard for the entire industry.
And what's just incredible about this slide is the consistency. Just look at this timeline. It's insane. Decade after decade, they backed the company that would go on to define the era. This wasn't a lucky streak. It was a repeatable process that built a brand that was second to none.
And that process, it was built on a culture of just brutal honesty, perfectly captured by founder Don Valentine's famous pitch-killing question: who cares? He wasn't trying to be a jerk. He was laser-focused on one thing. Is your product a nice-to-have or an absolute must-have? That incredibly tough, results-driven mindset became the firm's DNA.
And the result of all that success? Well, you can see it right here in the numbers. Their consistent, top-tier returns meant Sequoia could charge fees that were almost unheard of. LPs were lining up to pay 3 and 30 because getting into a Sequoia fund was considered an absolute necessity. They had more than earned that premium.
But that legendary status is now being tested like never before. The firm just went through an absolute perfect storm: a nasty market downturn, a very public and humiliating investment failure, and some serious turmoil within its own leadership. So first, let's talk about the macro environment. In 2023, the entire venture capital world just hit a wall. As you can see, the US VC index was deep in the red, while public markets were actually soaring. The easy money era that had fueled a decade of incredible returns was suddenly and very painfully over.
But this wasn't just a market problem. Oh no, Sequoia had its own very specific, very public issue. This number, $225 million, that's what they famously invested in the crypto exchange FTX. They even published a glowing 13,000-word profile of its founder.
And then, poof. Just a year later, the entire investment was marked down to zero. One of Sequoia's own LPs called the whole public spectacle a humiliation, something that had never happened in the firm's history. It was a massive blow to their reputation for rock-solid due diligence.
And as if all that wasn't enough, it all happened right in the middle of a massive leadership change. A new global head, Rayof Botha, took over just as the storm was hitting. And that was followed by a string of key departures, including the legendary Sir Michael Moritz. From an LP's point of view, that is a whole lot of instability all at once.
So you take all that, the market crash, the FTX disaster, the leadership shuffle, and what do you get? You get the single biggest, most dramatic move in the firm's entire 50-year history: the decision to completely break up its global empire.
You have to remember, for years, the big pitch from Sequoia was its global reach. And this chart really shows you why. I mean, sure, the US was the core, but their teams in Asia and Europe were huge and growing fast. They represented a massive part of their deal flow.
So here is the absolute key takeaway from all this. That unified global firm, it's gone. Sequoia China, which was arguably the most successful cross-border VC franchise ever built, is now its own firm called HongShan. The India and Southeast Asia team is now Peak VC. They are no longer partners. They are now fully independent firms that are going to go out and compete against each other for deals and, of course, for LP capital. Okay, so the global empire has been dismantled. Now what? What's the new game plan for the remaining US and Europe firm? Well, the answer lies in a completely new playbook, one designed to build a totally different kind of investment firm.
The heart of this new strategy is something called the Sequoia Capital Fund, which is an evergreen structure. And this fundamentally changes the traditional venture model. Instead of that 10-year clock ticking down, forcing them to sell winners, they can now hold on to public companies basically forever. Now, for LPs, that means the potential for some serious long-term compounding, But it also creates new headaches, right? Like, how is the firm going to value all these illiquid assets to manage the annual redemptions?
So if you're an LP, the mechanics of how you invest have totally changed. You're not investing in individual venture funds anymore. Instead, your capital goes into this one big master fund. That fund then puts the money into different subfunds. Any profits get recycled back into the main fund, and you get your chance at liquidity through these annual redemption windows. It's a major, major shift from the old way of doing things.
So why go through all this trouble? The reason is right here on this slide, and its name is Square. They saw how much value was created after the IPO. Square grew over 40 times after it went public. This new structure is designed to capture all of that long-term growth and create a more permanent, stable capital base that can ride out any market cycle.
Okay, so we've got the split, the new fund, the leadership chaos. All of it brings us to the bottom line. For any LP who's trying to figure out their position, these are the key questions and the metrics you need to be watching.
If I'm an LP trying to figure this all out, there are 4 things I am watching like a hawk. First, obviously, is performance. Can the new, smaller US and Europe teams still deliver the kind of returns that justify their premium fees? Second, you have to watch LP redemption rates. That's your real-time vote of confidence in this new evergreen model. Third, competitive overlap. How often are we going to see Sequoia, HongShan, and PeakXV all fighting for the same hot AI deal? And finally, there's the big intangible, the brand. Does the name Sequoia still open every door?
And you know, it really all boils down to this question, which comes from one of their own major investors. After getting rid of its global identity, the firm is kind of having an identity crisis. The old brand was crystal clear. The new one is, well, it's still being written.
And you really can't overstate just how much is changing all at once. As another LP put it, we're talking about a leadership transition, a global divorce, and a fundamental change to their investment structure, all happening at the same time. The risks are absolutely enormous, and honestly, the outcome is far from certain.
Which leaves us all with the ultimate question. Every great empire eventually faces a turning point. Is this Sequoia's moment of brilliant reinvention, of applying a new logic for a new era? Or are we watching the inevitable decline of a venture capital dynasty? That is the multi-billion-dollar question that you are now trying to answer.